Okay, welcome to our live stream today, March 2nd, 2026. Decided to do a little live stream today. Obviously, we had a pretty crazy weekend. I guess it was late Friday night when we had this attack on Iran, the U.S. and Israel, and that caused a lot of talk over the weekend and a lot of people speculating about what would happen this week with the stock market. And just a couple of disclosures. Obviously, everybody's investments are different. Do not take advice from a YouTube channel. Make sure you speak to your advisor one-on-one. And anything that's talked about on here is just purely educational. This is not to tell you what to do with your investments today. And also, in my investment philosophy and the philosophy of Evidence Advisors, is really a long-term strategy. We really do not make any changes to portfolios based on the day-to-day changes in the market, but it's a pretty unique situation over the weekend. And sometimes when things happen, it's nice to just get a reminder of what we do with our investment philosophy. So I have lots of things to share with you today, just kind of about how the market acted today. And this morning, pre-market and at the opening bell, lots and lots of people were talking about how this was going to be a terrible day for the stock market. And just goes to show that you really can't predict what's going to happen day to day, because that really did not happen today. So a lot of interesting things out there, but let's just go ahead. The market just closed, and let you take a look at, I'll share some stuff with you here on what happened to the stock market today. All right, so let's take a look at the Dow. The Dow just closed, and the Dow almost finished in the positive. It was really close. Let's open this up a little bit more. So the Dow started out way down this morning. When the markets first opened, it was down maybe about 600 points or so. And then throughout the day, it kind of bounced around. We were even in positive territory right here. And then at the end of the day, we only closed down 73 points or 0.15%. And year to date, just so you know, the Dow is still up year to date. We're up almost 841 points. If you remember, we hit the 50,000 point range just a few short weeks ago. And that is still playing out now, even through some of the down stuff that we had last week. So anyway, everybody thought the Dow was going to really take a big hit today, and it didn't. So let's go back to our watch list, and I'll just show you some other things that are in some of the portfolios. Let's take a look at the S&P 500 too, as far as what that did today. So the S&P, I think, actually finished in the positive. So let's take a look at the S&P 500. The S&P 500 also started out pretty low this morning, but it actually did. We got some green there. It actually did finish in the positive, barely up 81.81, or just basically flat from where it was. And year to date, the S&P 500 is still up about 33 points. So we're still in positive territory for the year with the Dow and the S&P 500. This watch list that I'll share with you just real quick. These are some of the things in the portfolio that one of the portfolios that I manage, and we've got some green and some red here, which goes to show you that diversification does work. This IVV is the S&P 500 for today, so we do have some of that in the portfolio. This is a large growth fund. SCHG was positive today. The two value funds were down a little bit, and these three green ones right here are small caps. So small caps did really well in the market today. And the rest of this stuff, this is international. This DFIV is international, and Schwab International, and another international fund. They were all pretty much down. This all came from really stuff that happened overnight. And of course, they traded down today because especially Asian stocks were down yesterday. And then we have some bond funds that kind of held steady. So as far as the overall market goes for today, I think many people were surprised that it wasn't more of a down day today, and turned out to be a pretty good day overall. I will say though that you really can't obviously predict what's going to happen in the market. I don't think it's a good idea to make a decision about your investment portfolio, especially if it's a retirement account or something, based on what happened today or what happens tomorrow. I don't really know what's going to happen the rest of this year, but I'm really confident in what's going to happen the next 5 to 10 years for sure. And I'll give you some data on what it looks like to kind of have this long-term perspective. I've used these charts before, but let's take a look at a couple things to just put that in perspective, what it means to kind of hold on to things, long-term. this is a great chart right here. It shows basically, this one goes all the way back to 1926. And you can see that the blues are the up market times and the reds are the down market times. So if you just didn't know anything else about investing and you just took a look at this one chart, I think it would be pretty clear that there's more ups than downs. And it's also one of the other things you can see when you look at this chart is that the ups are usually longer and they're quite a bit larger. So some of these down times, these 18 bear markets here were just pretty steep, but very short. And the recoveries tend to be longer and a lot more. So if you are faced with a year or something where you're having a down year, this is a great chart to just remember that, hey, there is a pretty good comeback that happens usually after this. And I can show you another way to describe that is with this chart. This is a same time frame from 1926 till today. So we're looking at just about 100 years. And what this shows is what happens a year and 3 years and 5 years after, big declines in the market. So the first one here, let's just say you had a 10% decline, all right, in a year. Well, 1 year later, on average, that the market is up 11.8% after a 10% decline. The 3-year cumulative, 34%, and the 5-year, 70%. And the same thing happens on a 20% and a 30% decline. There's always a 1, 3, and 5-year average on all of these years for the last 100 years. The 1 year, the 3-year, or the 5-year average return has been positive. So it's a good thing to remember just that when things are going so great in the market that, you can pretty much, based on this data, look at it and say, well, 1 year from now, 3 years from now, it is going to be a positive return after these big downturns. Okay, and then another thing to look at that's really important is also what happens year by year. And I think this one is actually, I think this is a great example of how to stay the course on a year-to-year basis. Sometimes there are points in the year, and this would have been one today, for example. This could have been a really down day. Now we had actually the end of the week last week was a little bit more significant in terms of a negative than today. And that really had to do a lot with what some people think is the AI bubble, so to speak. But that really happened last week. So we can take a look at, we'll be able to take a look at what the downtime was there when we stretch it out, closer to the end of the year, what has happened. But a lot of times what happens is you have a spot in the year where you have a big negative. And then you have a point later, when you get to the end of the year, that year is positive. So if you look at some of these, let's take kind of the most recent one. The last one here, we've had 3 really good years, 23, 24, 25, those last 3 years. But even though we did so well in those last 3 years, you may not have remembered that there was one point where we were down 19% in 2025. And that would have been all the tariff stuff that happened, in April of 2025. It really caused that. And a lot of people were like, oh my gosh, it's going to be awful. We're going to have these tariffs are going to blow up everything. And it didn't happen. We had a 17% return by the end of the year. And in 24 and in 26, we also had 2 periods where we were down at 10%, a little bit more than 10% in 2023. Now in 2022, we did have a down that just stayed down. And that was a combination of multiple things. But if you keep looking back, you'll see on all these good years, these positive years, there's always a point during the year where there's a big drawdown usually. And there's, the fact that would keep that entire year from happening just doesn't happen. So don't be too concerned when you have a big drawdown in the middle of a year or at the beginning of the year. You can end up with a nice positive return near the end, right? And one other thing here to look at is that you do have something that happens when you change from a 100% stock portfolio to, say, a 60-40 stock portfolio. And each one of these shows just how when you're 100% stock, you can vary pretty widely with your return. You get it up real high on the 36% on 100% stock and all the way down to drop to a negative 38. This would be in the last 25 years this has happened. The more you diversify, the more or the less volatility you have. So your fluctuation in highs and lows changes quite a bit. And most people don't have 100% stock portfolios, especially in retirement accounts. Most are in the 60-40 to 40-60. And just to take a look at a 60-40 portfolio this year so far, just to give you an idea of what's happened versus the S&P 500. Well, this right here is a 60-40 portfolio. The S&P 500 is flat or just a little bit positive at 0.68, but a 60-40 portfolio has actually done pretty well so far this year. So when you've seen some of those things on the news, especially last week, if you're a 60-40, 70-30-ish kind of investor, then you're not having that same experience as when, some of those large tech stocks, really take a hit and the S&P takes a big hit in a few days. A 60-40 portfolio actually right now is up over 3% for the year. Okay, so a couple other things to take a look at. Wanted to show you and remind you that it's really important, even if there were to be a big downturn in the market on a certain day, the next best day is always coming. And honestly, I thought, and a lot of other people thought, today would be a pretty bad day in the market, and it didn't turn out that way. So it just goes to show that I can't predict what's going to happen, neither can anybody else. But one thing I'll remind you is that these are some of the biggest point drops in the Dow Jones, in history. And a lot of them happened in 2022. In 2020, during those months of COVID. It was really crazy. And the largest one was on the 16th of March. But if you come over to the highest daily point gains, one of the highest ones was actually just a few days later on the 24th. And if you look at in this one right here in 2025, the highest gaining change in points of the Dow, it was almost one of the lowest ones back on the 3rd of April in 2025. So it was just a few short days later you had the biggest gain. My point of this is just to remember that when you have these days of big losses, do not panic or get out of the market at that point. There's no reason to, because you really might miss the next best day. So you never want to miss the next best day. And it's a really important thing to remember, especially if you're a long-term investor. And I just like to look at these charts and see when the largest point drops were, and then when the next highest one. And a lot of times they're not very far apart from each other. All right, and the last thing I'll share with you is a couple things from Guide to the Markets. This is JP Morgan. This is actually a public site. You can just go to Guide to the Markets and look up all kinds of nice, fun stuff on investing. And one thing I wanted to show you is that people ask me all the time, like, well, can I lose all my money? Or can I, how much am I going to lose this year? Or could I lose it all in 1 year? And I always tell people that time is a really important part of your investment strategy. Time and the purpose for your money is extremely important. And I also tell people a lot of times that I really don't know what's going to happen in a year, but I am very confident in what could happen in 5 to 10 years. And this chart really explains that. And again, if you take a 60-40 portfolio and you look at what could happen to that versus a stock portfolio in terms of positive returns, in one day of a 60-40 portfolio, they're using data from 89 to 2025. There's only a 53% chance that you'll have a positive return in 1 day. If you go out 1 week, there's a 60% chance. If you go out a month, there's a 68% chance. And if you go all the way out to 5 years, there's a 99% chance, which, I don't know what the 1% is that happened in there, but really there's virtually no chance you're going to have a loss in a 5-year period with a 60-40 portfolio. So if you're an investor with at least a 60-40 division between stocks and bonds, and you've got more than 5 years, you really have nothing to worry about. There's never been a time in history where that portfolio has lost money in a 5+ year time frame. So when something like today happens, or something like COVID happens, and you have a longer time to wait, it's really a good opportunity to just stay in the market, keep buying, rebalance, stay diversified, and keep pushing forward. So that's a great chart. I always like to refer to that just to remind people time is on your side. You don't need to worry about what could happen if you're more than 5 years away from something. All right. Okay, so I know it's a lot of data all at once, and I just want to take the time to just remind you that even though there are a lot of things going on in the world geopolitically, investing is still something that I think you can really benefit, especially long term. I think there's always a good time to, rebalance, and there's some great buying opportunities. I think the U.S. economy is still really strong right now. You have to go back and think about, what did we know about the economy, last Thursday, in regards to what was going to happen before all the war stuff broke out. And there are still some really good things happening in terms of corporate earnings. Companies are have a lot of cash that they're still going to be spending probably this year. We probably will have a couple more rate reductions possibly throughout the year. And there's a lot of other good things going on in the economy right now. Of course, there's still lots of things that need to be fixed as well. But in terms of the overall outlook for the year, I would say it's still positive. And of course, long term, I'm a long-term optimist. I always think the market will do well over time. So if you have any questions about anything, you ever want to reach out, give me a shout. I hope that helps you today. I don't know if you were nervous over the weekend or not about what was happening. Of course, who knows what could happen tomorrow or the rest of this week. It could be something different. The main thing people are worried about is this the strait that has a lot of the Straits of Hormuz, which is where a lot of the oil flows through. They're worried about that getting closed off. Currently doesn't look like that's happening. So that could continue to, make things okay as far as oil prices. And of course, as you know, oil has a big impact on the rest of the economy, but that's kind of the big thing everybody's talking about today. And we'll just see. And I think the president came out and said something like this could last 4 or 5 weeks. So I don't, nobody really knows when the end of it will be, but it does appear that it has not had as big of a negative impact, especially on the stock market in the United States, as we thought it would. And hopefully that will continue throughout the next few months and the rest of the year. All right. Hey, thanks for tuning in. Hope to do more of these in the future. So keep you posted. Thanks.